So welcome back to part B of Unit 3. I hope you've taken a nice break and you're ready to go again. So very simply, as I mentioned at the beginning of Unit 3, all principles predominantly applied in cash hours. I explained why. Don't forget, there's no exact science. Okay, it's a principle. Therefore, always manage your risk. Make sure that if you want to adopt these principles and really learn them, you're going to have to practice. Okay, through observation, through experience, experiencing lots of different situations, you're going to learn more about these principles and ultimately what they all mean. Okay, obviously don't forget all the rules of thumb as I go through them. Make a note of them, write them down. These rules of thumb are really, they come from years of experience, but do bear in mind they are just generalizations. Okay, and obviously each principle will be seen in the number of strategies that we're going to do. We're obviously doing 10 of them in this course, and I will identify all of these principles as we go along. Okay, so the first principle we're going to talk about is relative changes. Now, I've briefly introduced this relative changes concept earlier on in part A. So what is relative change? Okay, well, with regards to the footprint tool, it's particularly important. Okay, note obviously we only use relative change or speak of it when we are using time-based rotations and not the traditional rotation. Okay, now what's wonderful about relative changes, okay, is that a relative change is nothing more than a shift in dynamics, okay, and that shift in the dynamics provides us with a clue and a useful piece of information. Okay, if I can relate this, it's like watching a poker game. It's like that big call where two players are facing off against each other, and suddenly maybe the one player rubs his nose, okay, completely out of character. It gives that telltale sign. That's all that the relative shift is. It's the shift in dynamics, and ultimately when those dynamics change, the clue, okay, and this is what I'm going to show you through every one of the strategies. I'm going to show you that little clue that validates the trade strategy and the opportunity. Okay, the footprint obviously reveals the subtle changes which provides opportunity. Again, those subtle changes are the clues, and it's those dynamics that we need to learn and ultimately take advantage of. Now, in terms of some of the relative changes that we're going to utilize throughout this course, they're going to include volume, delta, price, and time. Okay, so whenever I speak about time or price or delta or volume, always I'm referring to the relative volume, the relative delta, price, and time. Just in terms of price, I think that's probably the least obvious. What I mean in terms of relative price is the dynamic or the price response. Okay, so in other words, it's a relative shift in how prices are being auctioned. So we can see the relative shift from, say, these two rotations compared to this rotation is very different. Okay, now in terms of where we're going to talk about relative changes, it's going to be throughout all of the strategies. Alright, let's move on to the next principle then, liquidity. Super important. Not many people understand the concept of liquidity. So the first thing to say is it a liquidity user or a provider? Okay, a liquidity user is someone that is taking the contracts, whereas a provider is someone that is giving the contracts. Okay. Now it's so important because someone who's using the liquidity is going to be using it for very different reasons than someone who's providing it. Okay, and this is where that sort of nuance comes in. Is that if you want to start to learn to interpret a lot more about the interaction, you need to be answering this question of, what was it? Was it a liquidity user or a provider? Are they passive? Are they aggressive in nature? Okay, the underlying reasons are ultimately super important. Okay, now liquidity obviously determines velocity of price and interaction between buyers and sellers. So what do we mean by that? Like I explained early on, if a market is rotating higher and trending higher, the amount of liquidity or the availability of liquidity will ultimately determine the velocity of price. Okay, so the velocity is just simply the manner in which price is moving between prices or oscillating between prices. Okay, now obviously if there's a lot of liquidity, we're not going to see much velocity. If there's little liquidity, we're going to see those shifts in velocity. Now, the underlying objective of the market, don't forget, it's to provide liquidity to those who require it. Okay, never forget that. Obviously we're all speculators, and I would assume everyone taking this course is a speculator, but at the end of the day, the big players, the big participants, they're there to utilize liquidity and to hedge themselves and to take on spreads and manage their books effectively. So don't forget that the very objective of the market is to provide liquidity to those who require it. Now, as a general rule of thumb, illiquid markets will trend until they find liquidity. Okay, so let me rephrase that. When markets are trending, if they are illiquid in nature, they will continue to trend until they find that liquidity. Okay, why? Because, well, if the market's trending, everyone is ultimately buying. They might be buying to be long, or they might be buying to get out of shorts. But ultimately, that buying will continue to persist until such a time that we run into the desired liquidity. And that's where the concept of liquidity premium comes from. In other words, in illiquid markets, okay, take for example in the housing market in London. Okay, let's say all of a sudden all the buy-to-let guys want to get out, they want to sell their properties. Well, guess what? The property market is extremely illiquid. So how do they get out? Well, they have to keep lowering that price until such a time that someone is willing to be a buyer, i.e. provide liquidity. Okay, when they find that liquidity, they can then offload that asset, and ultimately we get consolidation within the market. Okay, now note, breakout liquidity will be very, very different in a balanced market situation compared to a breakout situation. Okay, so when a market's breaking out, ultimately we're going to see a lot less liquidity being provided. Why? Because we're breaking out of key resistance. There's far less responsive sellers coming into the market providing that desired liquidity. Therefore, we're going to have a far more illiquid situation, and prices can therefore move a lot quicker. Okay, obviously in terms of a balanced market situation, we can see that both buyers and sellers are providing liquidity to the market, and therefore markets can remain relatively subdued and sideways. Okay, now in terms of this concept, just very briefly, I've got a nice little chart for you. Now, if I was to highlight illiquidity, I think one of the key sections is, now again, you're going to look at that on the footprint, you're going to say, oh, okay, that looks like an imbalance, which it is. Okay, so in illiquid conditions, we tend to get a lot more imbalances. Now note, the market auctions higher, it leaves this, imbalance area within the rotation, and once it finds the liquidity, it then starts to rotate sideways. Now note, obviously we spoke briefly about imbalances, so I'm just going to show you a neat little trick, but again, don't worry too much, we're going to spend a lot of time on this in the imbalance strategy section. Note, once the market gets back below that low volume area or imbalance area, what does it do? It stops back down in the opposite direction and we fill out the imbalance. Okay, that is one of the key strategies I will teach you in the imbalance section. Imbalances do get filled out and traded out over time. Okay, so obviously we can see a couple of low liquid areas on the footprint, but ultimately that is the concept of liquidity, which we are going to apply across all the strategies. Now, my single favorite part of the footprint chart, okay, delta pocket positioning. I'll explain this to you quite nicely. So very simple. I'll show you on the chart in the next slide. But very simple, delta positioning arises from initiative taken. Okay, so I'm going to draw this for you. There's our initiative from our buyers. Now, as the buyers are stepping in and buying, they are leaving a trace. They're leaving footprints in the market, and they're showing the nature of initiative. In other words, they're taking initiative to drive prices higher. Now, as they're moving prices higher, okay, obviously as prices move up, we are going to see a little bit of responsive selling, but ultimately they are accumulating positions on the way up, and those positions they will need to defend at some point. Okay, now as a rule of thumb, as the delta accumulates, okay, price must make headway on the objective. In other words, as prices are rising, and more buyers are coming into the market, and the delta is rising as well, we must also see price responding in that direction. Otherwise, like I said earlier, the component of time tells us that the longer buyers are unable to move prices higher, even though they are more aggressive in nature, that makes them more vulnerable. Okay, so if buyers keep buying and buying and buying and buying, but they can't move the prices higher, eventually what's going to happen is prices are going to turn back over and we're going to see those positions unwind quite fast. Okay, so that's the concept of then of the market delta positioning. Now, note, markets will always test pocket positions. Okay, so by pocket positions, all I'm saying is that accumulation on the way up in a trend, okay, it tends to happen over a couple of prices, and I'll show you this on the next slide, so don't worry too much. But note, when the markets do come back around, they're always going to test these position pockets. Okay, if they hold, obviously markets will continue higher. If they begin to fail, we're obviously going to see the potential for a footprint delta unwind, which again I will talk about a little bit later. So let's see what this looks like then on an illustration. The first thing is obviously, as we can see on the chart, delta pocket positioning appears with darker regions. Okay, so we can see price moving, so we're seeing the initiative, but then as we're seeing the initiative, we're seeing these little pockets of positioning. Okay, so this is effectively, we can see up here, we get some shorts in the market then moves down. Okay, so go from dark colors to light colors. Then again, we can see obviously the market still has these light colors. We see a bit of pocket positioning and dark colors, a bit of light colors, and pocket positioning again. Okay, now all the pocket positioning is it's simply the sellers are initiating here, they're running into liquidity, running into buyers who are responding to those prices. However, the sellers are still selling. Eventually, the buying gets overwhelmed, and again, the market then initiates lower until it finds that liquidity again, and we get that pocket positioning. Okay, now it's these little pockets of positioning that often get retested over time, and if they can hold on to those pockets, all right, the market will then continue in that vein. Now, what we can see very simply, obviously, the market provided a nice little pocket here. The market came back, tested that pocket, went back to the low, came back a second time, tested it again, and that pocket held ultimately before we then got the extension to lower prices. Now, very interesting, just note in terms of delta and volume, with the pocket positioning and this type of initiative, obviously, we're always going to see a pickup in volume, nice strong relative pickup in volume, and we're also always going to see the delta respond. Why? Because the very definition of delta pocket positioning is that within this zone and this zone and this zone, there is more selling than buying. Okay, that's why it's creating that very red pocket of positioning. Okay. Our next principle then is the delta unwind. Now, as the name suggests, it's very simply when the delta in the market gets unwound. Okay, so why does it get unwound? Well, short-term positioning becomes unstuck. Okay, like I said to you, time is a key proponent in the auction process. If a market is unable to move prices in the direction it's going, and over time, eventually those positions are going to fall underwater, and they're going to have to unwind themselves. So that's why it's so important that when a market is long and you feel there's initiative, you always want to make sure you're keeping an eye on time, as a good basis of how are the buyers progressing, how are the sellers progressing. Okay, now note, in terms of the positioning, when there is liquidation, this is the key to understanding a delta unwind. When we get below that point, so let's say, for instance, the market had been initiating, this was our pocket position. Okay, I'm going to call it a PP, our pocket positioning. The market comes back down. Ultimately, once we get below that point where the buyers, or the buying threshold, we get below that point where the buyers are going to stop out. Note that stop out, or below that point, the liquidation is not price sensitive. And what we mean by that is that those buyers are not concerned about what price they get out at. They're just concerned about getting out. And that's why when you take out these pocket positioning, we do tend to get very volatile stop downs or stop ups in the market. Now, I always talk about clues, and one of the beautiful things about a delta unwind is that there are always these little subtle clues before we get the delta unwind. And again, like I said, don't worry, this is just the introduction to the principle. I will show you the strategy in great detail later on. But there is always a clue, and it comes in the form of absorption. Now, we spoke about absorption earlier and what it means, but ultimately, just before we get the unwind, you'll always get a little bit of an absorption. So I'm going to show it to you in the chart next to us. What you can see, obviously, is prices were rising nice and aggressively. We had the delta accumulating. We can see the cumulative delta on the day was nice and high in this example in the gold. We can also see a real big shift in the volume dynamics as well. And all of a sudden, the market begins the process of turning around. Now, the first thing I want to show you is, notice how once we took out this bit of pocket positioning, we had a little bit of light color in between. In other words, the market very quickly auctioned up, but once those sellers had sort of shown their might and shown their strength, they very quickly initiated to the downside. Now, notice I said you will always get the process of absorption before a delta unwind, and that's it there. You can see a real pocket of positioning there, a lot of volume transacting in that little zone over 4 prices. Once we took out the bottom end of that, notice the price response. Okay, very, very quick, very, very volatile, very, very tough conditions. Anyone long are just trying to get out. Again, notice the imbalances. Okay, a lot of imbalance created by the stops coming from buyers getting out of their position. Okay, and that's pretty much what the delta unwind is. We unwind this delta that's built up into the position, and ultimately you can see if we look at the delta on the day, it goes from positive 1200 all the way up to positive 1600, and then very quickly reverses as prices sell off to the downside. Now note, as a rule of thumb, an imbalance created by a delta unwind will be filled out. Okay, so what do I mean by that? In the example, we've created an imbalance here. Okay, why is that imbalance being created? It's not fundamental, it's not technical, it's just simply a bit of short-term positioning coming unstuck. As a rule of thumb, at some point this market is going to come back here and it's going to fill out this area. Okay, again, I will show you that a little bit later on when we talk about imbalance strategies. Obviously, we are going to see the strategy a lot in the footprint delta position unwind strategy. Okay, now, bad high, bad low, it's very simple. Okay, a bad high is where a market effectively transacts a high amount of volume at an extreme point. Okay, so a lot of volume is transacted at an extreme point. Now, the reason we call this a bad high and bad low stems from the original concept of auctions, which are what? An auction is to facilitate buyers and sellers between a premium price and a discount price. So by that very definition, we don't want to see a lot of transactional work up here, okay? Because if there's a lot of transactional work at a premium, that's not an effective auction, and we call that a bad high or a bad low, okay? Equally, it can also be where a market effectively tests or rotates a number of times on a certain price point, and I'll show you that in a few examples. So note, in terms of the colors, you're going to see a lot of dark coloring at the extreme points. Okay, that's what it'll look like on the footprint chart. Now note, a bad high or low constitutes an anomaly, or a failure of a market to correctly facilitate trade. So when we pick up on these anomalies, they always correct themselves. As a rule of thumb, anomalies will correct. But there is a caveat, and this is a mistake a lot of traders make. They don't have to correct straight away. They can take time. Now, some of the other kind of anomalies you might have heard of are things like gaps in markets. Okay, gaps are an anomaly. All right, they do eventually get filled out over time. Okay, so that's one of the anomalies, which is a bad high or bad low. Now, to represent that in terms of a candlestick, so you can see it, this would be something what we would call a bad low in terms of price. Why? Because we can see that this market gold has tested this price point once, twice, 3 times, 4 times, 5 times. Okay, so it's a really, really badly auctioned low, and at some point the market is going to take that out and move lower. Now let's see what that looks like on the footprint. Okay, so it's very simple. What you can see in the first example is that in this market we transacted 240 contracts at the lowest price. Equally, we can see not just one, but two, but three rotations stopping at this price point. Okay, so what this is telling us is that there's a reluctance at this point in time to take out this price area. Now again, note, we call it an anomaly, we make a mental note of it and we write it down on our sheet, but eventually this is going to get taken out. Now don't forget, if an imbalance is created once we break below that point, eventually that imbalance will get filled out and traded out. Okay, so that's what it would look like on the footprint, and just another example to show you what a good high should look like. As you can see, again, the market comes up. Now note why this is a good high. Well, it's very simple. The market's come up, it's probably stopped up here, okay, but what we've effectively seen is a real a lack of trade at these higher prices, and ultimately the market very quickly auctions again back down. Okay, and we can see that obviously because the market closes substantially lower than where it got to. Okay, so that's what a good high would look like relative to a bad low. Okay, now obviously what we're going to talk about now is delta shading, quite an important principle. Obviously the footprint is based on the shading of each segment, so I want to give you a general understanding of that shading. What I am going to say from this point forth, don't get too bogged down into every single little price. Okay, don't look at every single price and say to yourself, okay, what does this shading mean? What does that shading mean? Right? It's about understanding the shading in general in each rotation. Okay, it's about understanding the shading around key points. Right? So if we have a key breakout, what is the shading looking like at that breakout point? Right, because it's that shading, that recognition of a potential pattern, that's what we're after, because those patterns we can recognize over time in a number of examples. So, delta shading is the relative interaction at each price. Very simply, who wants to buy or who wants to sell more and why. That's what it is, guys. Every single price here represents who wants to buy more versus who wants to sell more. Okay, now, this is obviously, as I said, it's the key element to the footprint. Now, because we can visually represent this, that's why we need to have some sort of an understanding of what the color scheming means. Now note, like I said, the color scheming doesn't depend on anything other than the strategy you're trying to execute. Okay, so you are going to see very specific color scheming when I show you the auction reversal strategy. You're going to see very specific color scheming when I show you the imbalance strategy. The key is for you to develop an understanding of what kind of color scheming you want to see based on the strategy you're trying to execute. Okay, so what matters most is considering the shading in the context of the strategy. Now, like I said, with an example of a breakout, there should be lighter shading, as definition of breakout suggests liquidity is a premium. Okay, so the principle of a breakout, we take out big resistance, everyone's a buyer, therefore there's no responsive seller. So this section here should be very, very light in terms of the footprint. Okay, now if we know that's what the pattern should be, when that doesn't occur, that's an anomaly. That's something we can obviously go and make a mental note of, because in that instance, that breakout might not be as effective as it should be. Okay, and that's what we're after. Remember, this entire course is not about, having opinions of the markets. It's not about having guesswork. It's simply having an exact strategy and applying it to the market when the market is showing that specific opportunity. Okay, now as another example, when we are in imbalanced markets, you can expect large pockets of dark shading. Okay, so like you can see in the example here, we are in relative balanced area, so we can see dark areas, dark areas. Now, if we sat there and just started interpreting this as, potentially it's a buy, potentially it's a sell, right? We're not going to go anywhere. Right, and that's why what we're going to do when we get to the strategies is we're going to explain the strategies. We're going to spend time developing the strategy, and then I'm going to show you what you should be seeing based on each strategy. Okay, so important thing to remember with shading, it will never be the same. Never, guys. It's never going to be carbon copy. Right? There's just too many different strategies, too much noise for it to be exactly the same. But right, there will be very, very unique similarities that exist. And that's what pattern recognition is all about. It's about finding those similarities and applying it accordingly. Okay, obviously the concept of delta shading and will be applied to all of our strategies. Just a brief word on the cumulative delta. Like I said when we set up the tool, the cumulative delta is simply just the delta being added up over all the rotations. Okay, so if every one of these is a rotation, 1, 2, 3, 4, and 5, the cumulative delta is just simply this delta in this rotation, okay, plus the delta from rotation 2, plus the rotation in delta 3, 4, and 5. And what it does is it's simply just accumulated over the period of a day. Now, the reason this is very useful is because it gives us a very good snapshot of what the delta is doing over the course of the day. Now, what I am going to say is be very cautious, and I hear this a lot on our trading floor as well. People assume that because, say, a delta is negative, that the positioning is short. Okay, now factually that is incorrect. Okay, it doesn't mean just because a delta is negative that the market is short. All right, so from day one, get that out of your head, because that's a very dangerous approach to take. All right, what it does mean if there's a negative delta is it means that there has been more selling versus the buying. In other words, there's been more aggressive selling than aggressive buying. That's what it does mean. Now, what I will say, okay, is that if a market is trending and it's showing very clear dynamics in terms of price in one direction, as mentioned, as a rule of thumb, you want to see the cumulative delta rising in the direction of the trend. Equally, if it's a downtrend, you want to see the cumulative delta getting steadily negative over time. In that instance, we can assume that the delta is reflecting the positioning. Why? Because prices are moving higher and higher. Remember, guys, positioning means that as markets go up, right, we're seeing buyers enter and hold position. We're seeing buyers enter higher up and hold position. We're seeing buyers enter and hold up higher. That is what positioning is, okay? Just because a delta is negative or positive does not imply there is positioning. Okay, so what we will do, and I will show you this in unit 4, is I will show you how to set up a histogram of the delta on the day. And what's lovely about that histogram is it's a lovely little bar chart that'll be right here on your footprint. And what you can see is you can see certain divergences between when, for instance, prices are trending, but the delta is going in the opposite direction. Okay, and we will talk a little bit about that in unit 4. Okay, let's move on to the next principle then, accumulation and distribution. Now, I said to you very early on in Unit 3, I said distribution accumulation, okay, or absorption does not equal consolidation, okay? And a lot of people make this mistake. It's not the same thing. Right, because accumulation or absorption is a aggressive thing. It's initiative being taken, whereas consolidation is just simply noise. It's the market oscillating around the mean. Now, the most important thing to be able to do is to differentiate when the market is doing this process of accumulation, okay, and when it is just noise. So when it is accumulating, that's something we need to pay attention to. When it is noise, it's simply just oscillating and consolidating, and we want to try and avoid that. Okay, now like I said, accumulation will have relatively high volume. That's the real standout clue, right? A market can be moving sideways in a sideways range, but ultimately if it's being done on high volume, okay, that's suggesting there's actually quite a bit of accumulation or absorption taking place. Okay, I want to just write that down so you guys get the difference of the words. Absorption means accumulation, but it does not mean consolidation. Now, note, as we get this process of accumulation, all right, we call this coiling, or an elastic. Okay, it's a bit like, you know, when you start pulling an elastic back further and further, eventually that elastic is going to snap. Okay, so when you see this process of accumulation or absorption on high volume, this coil eventually needs to trigger a movement in one direction or the other. Okay, and it's that trigger that we're very interested in because it provides, again, very good initiative opportunities. Now, again, like I said to you, I'll show you what the triggers are as we go through the strategies, but the important thing is that you're going to see a shift in dynamic. Now, let's briefly look at the example and I'll show you the little clue here. What we can see, again, the market spent a process of accumulating and absorbing. We could see, obviously, again, note the responsive price action at the low and responsive at the high. Again, responsive at the low, responsive at the low, responsive at the high. So a lot of responsive type price action, no real initiative. Suddenly, bang, initiative steps in. Now, straight away you got to look at that. And, if you were just eyeballing that, you're going to see what the real clue that was there. Okay, if you go and compare all of these rotations, something really sticks out. Okay, and it's this little bit of an imbalance low volume area that sticks out. Okay, so we get this low volume area, it breaks out of this previous little rotation, we get the extension, again run into some real pocket positioning, and the market then comes back, tests that low volume area, fails, and continues in the direction of the trend. Okay, so that trigger there, it was a shift in dynamics, which is i.e. a nice little imbalance as the sellers stepped up and began the process of initiation. Now note the volume dynamic on the initiation, a lot higher, substantially higher in relative terms than the previous couple of rotations. Also note the delta shift, okay? Not a great deal of delta shift, and all of a sudden we see that delta shifting dramatically. Okay, we almost see the delta doubling in relative terms over a period of 4 rotations. Okay, now note in terms of accumulation and distribution, this is the accumulation phase. Alright, and once it snaps, once we begin the process of distribution, we then get the snap and distribute and the initiative. Okay, so as I've said here, rotations will have 100% overlap. Okay, so what we can see is these rotations are all overlapping one another, and ultimately they're filled with a lot of dark delta segments. So we can see lots of dark segments all over this accumulation distribution, and that's really key. Okay, because remember what I said to you, accumulation and absorption does not equal consolidation. We said one of the key differences is that there is high volume. In other words, there are these dark patches. Okay, if there weren't these dark patches, it's most likely a form of consolidation, and that's the key standout. When you see really light areas of sideways trade, it's probably just consolidation. When you see areas where there's quite dark patches, that is absorption and accumulation, and that's something you want to be switched on for the break of either side. Now note, we are going to apply these strategies in, again, the absorption auctioning strategy session, the breakout trading, the initiative drive, and the failed break of support and resistance. Okay, so the next principle we're going to pay attention to is that of tail auctions. Now, to best explain a tail auction is to actually just illustrate it. Now, what it'll look like very typically is that of either an inverse V, as we can see in the first example, which we call an inverse V reversal, and the second would be just a traditional V reversal. Now, the reason it looks like this, or the reason we call it a tail auction, is that when we get initiative to initiative type price response, okay, it will tend to leave a candlestick that looks a little bit something like this. Okay, so in the first example, obviously, that would be the inverse V reversal, and the second example would be the V reversal. Now, the reason we call it the tail auction is simply because we get a big fat tail left on the candlestick. Now, note, obviously, it's very rare to see initiative to initiative type price response. Obviously, as we went through the principle of initiative and responsive, one of the key highlights was that markets tend to move from initiative into responsive, then either back into initiative or into a responsive type responsive price action. It is very rare to see initiative to initiative, and therefore, if we do see initiative to initiative, it does signal out a very important turning point in the market. Okay, so these turning points can last for at least that session, a couple of days, even sometimes a couple of months. So very important to learn this principle, understand this principle, and when we talk a little bit about strategy with regards to this principle, you'll get a better understanding of how you can execute it. Okay, now note, obviously, because it is initiative to initiative, we are going to see a very aggressive nature of the market. Okay, so we have initiative on the way up. I'm just going to draw this here. We have initiative on the way up, and then we have initiative on the way down. Okay, obviously we got the buyers initiating on the way up and the sellers initiating on the way down. Now, because of the initiative in both directions, we are going to see a lot of volatility and high relative volume and delta. Now note, because it's such a key turning point in the market, we do want to utilize a nice dark blue line so that we know obviously it's a key turning point, but also we know it's a key positioning point. In other words, there could be a really good breakout at a future date once we take out that point in the market. Now, as a rule of thumb, and I'm going to explain this on the chart again, as a rule of thumb, what you will tend to see is as we're going up, so as the market's initiating, we might see a couple of imbalances, but eventually we're going to see some darker shading forming towards the extremes. Okay, now what will then happen is the market will run into initiative sellers. Okay, the market will start to turn lower. It will then again run into some really dark shading. Now on the way up, obviously it's buying, so we're going to see some dark blue. Okay, and on the way down we're going to see some dark red. Okay, now on the way up it's obvious you've got sellers that are providing liquidity, happy to get hit. Why? Because they're obviously about to initiate shorts as well, so they're happy to get filled. And then obviously as the market turns back over, this responsive price action in the dark red is simply the buyers that maybe are trying to get out of this very aggressive up move. It could also be some algorithms that sold on this last move higher that are maybe taking profits, and it could also obviously be just some other time frame participants trying to get long. So it's what we call secondary response buying. Now the key point is once we take out that low left from those secondary response buyers, we will then ultimately have the continuation of initiation in the sell side direction. Now note, we can also obviously see imbalances on the way down. Okay, so that's the rule of thumb. That's the three principles to identifying a tail auction. One, we have initiative. We run into a little bit of responsive selling. Obviously the initiative selling then steps in quite aggressively, and we run into some secondary responsive buying before then seeing the continuation of the initiative selling. Okay, now obviously if I drew that on the V-shaped reversal, similarly we'd see some initiative selling, run into some darker shades red this time. That will be obviously the responsive buying. The initiative buying will step in, take it back bid, will run into some responsive secondary selling before the initiation continues in the opposite direction. Now note, speed and time is a very important determinant for this strategy for obvious reasons. If we need to see rejection. Okay, so initiative by the very definition shows us very strong bias in one direction or the other. So time is an important way to measure how strong this buying in the opposite direction is. So we do pay close attention to obviously speed and time. Do note sometimes obviously the strategy can look a little bit something like this. But ultimately, it's not quite symmetrical as a V, but the principles are there. So that's what's key here. Yes, if we have the more V-shaped or the more inverse V-shaped, they are better examples. But ultimately, so long as they follow the three principles I outlined for you, the tail auction is in play. Now note, time-based rotations will be slightly better and easier to see this. Why? Well, it's very simple. If we had just a normal rotation based, the rotation might close here, the next rotation might open there, and it might continue. Whereas a time based, you're going to see very clearly the rejection and the reversal. Okay, obviously with a time based, what we do tend to sometimes see on the initiative in the reverse is we do tend to see the concept of one-time framing. So again, you're probably going to see that a lot easier on a time-based versus a rotational-based. Okay, do note we're going to see a lot of this in the key auction reversal strategy section. So not to worry, we will spend a lot of time focused on the strategy later on. Let's look at some examples now. Let's get to the charts. So the first example, as we can see, I'm going to highlight the principles for you now, so we can see some real aggressive sell side absorption coming in here. One last little bit down there. Do note then the market goes back bid, so we see the initiative come into the market. We run into those secondary sellers on the way up. Once we take out those secondary sellers, we then see a little bit of a holding pattern before the market then extends higher. Now note, obviously, highest volume of the day, okay, as well as obviously the highest delta. This is to be expected. Why? Because we're seeing initiative in the direction of the sell side and initiative in the upside direction. Okay, now obviously do bear in mind what you will likely see is you'll always see the cumulative delta unwind, so we can see negative 4,200 becomes ultimately negative 1,400. Why is this? Simply because we had initiative to the sell side and then initiative to the buy side. Okay, so that's our first example. Let's take a look at another example. This is a little bit more of a symmetrical V shape. In essence, again, let's highlight the key areas. So we can see a great deal of darker shading, some real sell side aggression come into the market. We then get a little bit of an extension, also a little bit of an exhaustion low here, which we'll talk about in the next principle slide. And but ultimately, once the market goes back bid, we run into those absorption sellers, those secondary sellers. Once we take them out, the market then extends. Note the color difference. Okay, notice the light shades versus the dark shades. Okay, a little bit of an imbalance before the initiative continues to the upside. Also notice, obviously these are 30-minute time frame rotations. Just to highlight that most of these principles can be adopted on any time frame really. But also notice, obviously, the cumulative delta goes from negative 509 to positive 2,000 on the day. Okay. Again, also, for those that are more traditional candlestick traders, this would have been an outside candle. Okay, so you can see it engulfs the previous candle. Again, shows a real strong, initiative off of that low. Notice the blue line as well. And then obviously notice the next candle. We open at the low and we pretty much close towards the high. Okay, another example. Again, our three principles. We can see our real aggressive selling coming in here, darker shades. We then obviously get our bid back up. We then have our last little bit of sell side responsive coming into the market. We then take out that high and the market begins a process of one-time framing. Again, notice the delta. We have all the initiative there, highest delta on the day to the downside, and then obviously the highest delta to the upside. Okay, so again, just really covers those three principles, which are, first off, obviously as the market sells off or rallies, we see initiative. We then run into a little bit of responsive, as we can see here. Once we find that responsive, we're waiting for that initiative to turn back around. We see that responsive on the other side, and once we take that out, we then continue in the opposite direction. Okay, so that's our tail auction principle. Now, the next principle we're going to cover is the exhaustive high and low, and also known as a stop run. Okay, so in essence, it's nothing more than stops triggered. Now, stops can be triggered in a number of ways. Either someone can hit the market and they can take out a number of prices, or they can begin the process of stopping down, where they simply just paying down. Okay. The difference in two is very simple. Someone who hits the market, you're going to see something, probably not yet, but you're going to see a whole bunch of zeros. Okay, so you'll see ultimately something like 230 times 0, 100 times 0, 80 times 0, 150 times 0. Now how this works simply, if someone is stopping out and they need to sell 1,000 contracts, they're taking the liquidity at all these prices, and obviously because they're selling 1,000 contracts, there will be no counter bid. Okay, that's why you see the zeros. So again, as a general rule of thumb, if you do see a number of zeros after each other, not just one, but a number of zeros after each other, that simply shows you stops in the market. As you can see, obviously we do have examples here where we do only see 1 0. That does not imply stops. That's simply just someone sold 53, but there was no buyer at that price. Okay, so now that you know that you can get two types of stops, note obviously when we do have this exhaustion high or low, it comes at an extreme point, and most important, it comes after we've already seen quite an aggressive move. Okay, so all an exhaustion high and low is very simply the market's overextended itself, it's gotten ahead of itself, and it's now, for lack of a better term, is now overbought or oversold. Okay, now most important, as a rule of thumb, an exhausted market does not imply a low or high. Okay, that's a mistake people make. Just because a market's gone too low or too high does not imply that that's the top or the bottom. What it does, however, imply as a rule of thumb is that markets tend to take a break. Okay, so when you do have an exhausted market, it always tends to take a break. Now, that break comes from one of two reasons. One is a little bit of profit taking. Okay, so anyone short in this example wants to take a little bit of profits. Why? Because the market has it's exceeded the number of prices it typically would. Also, you get a lot of relative value strategies, particularly by algorithms, where once a market gets beyond a certain threshold or beyond a certain variance from the mean, they do tend to then look to fade the market. So just bear that in mind. That is why we get the taking a break ultimately. Okay, now note, because of the excessive volatility, we will see exaggerated price response at extremes or within range. In other words, when these stops go off and we get the stop run, it's going to look quite aggressive. Okay, the market's going to thin out quite a lot, and it's going to be quite volatile. That being said, obviously we will likely get the highest delta, the highest volume, and the widest rotations as a result, for obvious reasons. Okay, if a market's stopping down and exhausting itself, there's a lot more time frame participants in the market, which by definition means more volume and obviously more volatility. But also, the reason we have the most negative delta is very simply, if someone is stopping down, they're going to take out all the prices from here to there, and they're only going to be a seller, which means we're going to see a very negative delta in this example, whereas if it was buying to the upside, we'd see a very positive delta. Now note, the market stop is defined by how big the stop is and where the liquidity is being provided. Now, one of the biggest mistakes I used to make, and a lot of traders make still today, is they try to catch a falling knife. Now, you're doing yourself an injustice by doing this, and I'll explain to you why. Okay, when a market is reaching what you think is overbought or oversold conditions, okay, that's important to understand, but that's not a precursor to fade. And I'll explain to you why. Okay, when a market reaches this point of overbought or oversold, there's likely to be stops in the market. Now, when a stop is executed, and I'll explain to you how a stop is executed. Let's say this is the oil market. So let's say there's a 5,000 contract sell stop order. The moment he enters the market to hit the market, he's going to take out as many prices required to fill his order. Okay. Now, we don't know how many prices that is. Nobody knows. Okay, because nobody knows how thick or thin the order book is. Okay, so if there's a lot of liquidity, he might only require 10 prices to get 5,000 contracts. If it's a thin order book, he might require 30 prices. Okay, so by that very nature, you standing in the way of providing liquidity, you're doing yourself an injustice. Okay, in this trade strategy, you do not need to get the best price. Okay, you do not need to guess. As you'll see in the strategy session, I'm going to show you how to identify this trade strategy and make money from it. Okay, but just bear in mind, the reason you don't try and catch a falling knife is because you don't know where that knife will ultimately stop. Okay, and that's the key crux of what I'm trying to explain to you there. Now note, we will talk a lot about this in the exhaustion high or low strategy, as well as the footprint delta unwind strategy. Now our last principle is all about color lines. Why do we use color lines? It's simple. You want to be able to, or you use color lines so that you can easily, quickly identify what each price represents. Okay, when you look at a footprint, you know if you have different color lines, you can straight away go and say, okay, that's a high of yesterday, that's a weekly low, etc., etc. Okay, so color lines just simply identify a price. Okay, now note, obviously you need to be responsible and keep it up to date. Otherwise, you come in the next session and you're executing off lines that are no longer relevant. Equally, keep it simple and effective and consistent. Okay, that's the mistake I see a lot of people make. They lose consistency in applying this process. Okay, this process will help you tremendously. So do consider the idea of color lines. Now, I'm going to give you a couple examples of the color lines I used, and just to give you an understanding, obviously, when I did adopt this process, it took me roughly, I think, about 2 weeks until it became a really good habit. Okay, so what I suggest you do, start off with a couple of lines, maybe 3 or 4 color lines, what they represent to you, maybe even something simple like a previous day high or low, and start building a consistent approach to applying it. Now, some of the examples I have, obviously, daily high and low, I use a brown line. As we can see here, 161.50. For weekly high and low, I use pink. As we can see, 161.88. Red lines I tend to use for key reference points. So if I want to highlight where, for instance, maybe the oil inventories data came out, or maybe where a key piece of economic data came out, it's just simply a color line that I want to reference a certain price. Now, orange shows us high volume areas. As you can see, there's quite a lot of pocket for high volume areas, as we spoke about earlier in this unit, and where there's been high delta absorption. Dark blue is for key breakout areas, or as I mentioned in the last couple of slides, where we have tail auctions. Turquoise is for initiative, where the initiative begins, and again, you'll understand this a lot better why I utilize initiative lines when we get to the strategy on support and resistance, or at least failed break of support and resistance. And then lastly, green lines for imbalances. As we can see, the example of imbalance, when I explain the strategy session on imbalances, what the 3 strategies you can execute are, again, you'll understand why it's effective and important to have color lines. Okay, guys, that brings us then to the end of Unit 3. Now, what I am going to say is, obviously, we have dealt with a lot of principles. Some of them may be new, some of them may be not so new, but what I don't want you to do is panic and worry that maybe you don't quite fully grasp one of the principles, because when we go through every one of the units, 6 to 15, when I go through each one of the strategies, I'm going to show you what the most important principles are within each one of the strategies. That way, you'll begin to practically apply the principles that we've dealt with in Unit 3. Okay, in Unit 4, we're going to move on to the more advanced elements of the footprint tool, how to set up, for instance, imbalance footprints, as well as some of the other nuances of the tool. Alright, guys, well, I'll meet you up in Unit 4 again.